Assalamualaikum class. Today is lecture number 24 and we are going to discuss chapter number 14, that are capital budgeting decisions. First of all, we need to know what is capital budgeting. Capital budgeting is used to describe how managers plan significant investments in projects that have long term implications, such as the purchase of new equipment or the introduction of new products. So these type of investments will be considered in capital budgeting decisions. So in capital budgeting, the term typical capital budget decision is there. In typical capital budget decision, the cost reduction decisions are there. Should new equipment to be purchased to reduce cost, as new equipment will increase our efficiency? Expansion decisions, like the new product should be introduced to increase the scale sales. New warehouse should be purchased to increase the storage capacity. The third type of decision that come in typical capital budgeting decision is equipment selection decision. Which of several available machines should be purchased? The fourth type of typical decision is lease or buy decisions, that whether we need to buy an equipment or we need to acquire a equipment on lease. The fifth type of physical capital budgeting decision can be equipment replacement decision, that whether a new equipment should be replaced or not. There are two categories in capital budgeting decision. The first one is screening decision. The second one is preference decision. The screening decision and preference decision. In screening decision, the manager has to decide whether a proposed project is acceptable, whether it passes a preset hurdle. It is the screening decision in which the manager will propose the project and see its hurdles. For example, a company may have a policy of accepting projects only if they promise a return of at least 20% on the investment. So, a required rate of return in the screening decision is 20%. But in the case of preference decision, the manager will decide those projects among the alternatives in which there are some qualities. Like if we explain, if a company or a manager, purchase manager, select a machine from many machines having different types of qualities, features, and he select the most efficient machine, that it is his preference decision instead of screening. In screening phase, if we are dealing with machines, it means the manager will propose a machine and see its hurdles and consequences. But in preference decision, the manager will select among the alternatives machines, that what type of machine is beneficial for the organization, that will be its efficiency will be preferred. Then comes the concept of time value of money. I hope in your business finance or financial management subject you are well aware with the time value of money. In time value of money, we are dealing with cash inflows and outflows, their future returns, the required rate of return concept is also there. In time value of money, we will be able to explain the present value of investment, the future value, with equal cash inflows and cash outflows. What will be the cash inflows and cash outflows? I am going to tell you soon. First of all, what will be the formula of present value? Like if we want to know that in the future, well, in future we will be able to get, we want to get a 30,000 rupees in future. How much amount of investment should be done today that we will be able to get a 30,000 future value? For that purpose, we will decide the number of years of our investment. That will become the part of number of years. And what and how much return or how much rate of return is offering, it will be written here. We will be able to know the 30,000 return value today, present value. In the same way, if we want to know the future value of this present value, our formula will become present value into 1 plus rate of return into number of years. Our today's investment return in the future will be calculated by this formula. So these are the formulas to calculate the present value of our future return and to know the future value of our present investment. Now, there are some consequences with the present value. Listen carefully. If our present value is positive, it shows that the project should be accepted because it promises a return greater than the required rate of return. It means our present investment is more greater than the our present value return will be greater in future. But if the present value is showing the zero result, it means our present value and future value, our initial investment return in the future will be equal. The amount we are investing today, we will get the same amount in future. But if the present value is showing negative value, it means we should not accept project because in future we will get loss. Present value negative value shows that our future return on investment will be a loss. As we are dealing with capital budgeting, so we need to know what is a working capital. In working capital, our current liabilities are deducted from current assets. Current assets include cash, account receivable, inventory, and marketable securities. In the same way, our current liabilities includes account payable, our short-term liabilities. So working capital can be calculated by taking the difference of or by deducting current liabilities from current assets. So what type of cash payments come in cash outflows, and what type of cash payments come in cash inflows? In cash outflows, the initial investment, increased working capital needs, repair and maintenance, all these type of payments will be included in our cash outflows at as our amount is going out. In comparison of this, what are our cash inflows? In cash inflows, our revenues, reduction in costs, release of working capital, all these type of cost will come in cash inflows, like our returns, our sales, our payments, like account receivable. If we are collecting the account receivables, then it will be considered as cash inflows. As in the formula of present value, there was rate of return is there. In the future value, the rate of return is there. There is a concept of factor of internal rate of return. It will be calculated as investment required divided by annual net cash inflow. Like our investment that we need to do is 16,950, and our annual cash inflow the amount that we will be able to get annually is 3,000. So our factor of internal rate of return is 5.650 times. It means it will take us 5.65 year to get the investment of 16,950. Then comes the concept of profit profitability index. In profit profitability index, the net present value of the project will be divided by investment required. We will be able to know about our profit, how much profit we will be able to get by dividing the net present value with the investment requirement. As we are discussing about the profit profitability index, another concept is payback method, that the investment we are going to do, how much period we will be able to get our initial investment back. It will be the ratio of investment required with annual net cash inflow. This formula will explain us in how much tenure we will be able to get our initial investment back. Then comes the concept of simple rate of return. The simple rate of return can be calculated by dividing annual net operating income with initial investment. By dividing annual net operating income with the initial investment, we will be able to get the rate of return, the rate of return. When we will calculate the simple rate of return, there are some criticisms that created problem to calculate the simple rate of return, because this method ignores the time value of money, as the time also matters, that for how many years our initial investment will be given back. So simple rate of return formula was criticized because it ignored time value of money, because time value of money contains the rate of return amount, the number of years included. As if you see in this present value formula, the rate of return was there, the number of years were there, the future value was there, but in simple rate of return calculation, only net operating income and initial investment amounts are taken. After all these type of formulas or terms, the concept of post audit of investment projects is there. Post audit of investment project can be defined as, it involves checking whether or not accepted results are actually realized, that the calculation we have performed, whether they are up to the mark, whether our projects will be successful or not, whether we are will be able to get good results or good revenues. So all these type of things will be considered in post audit. Now, after discussing all these things in capital budgeting decisions, I am posting a question related to these all these type of formulas that I have discussed. Now you need to implement those formulas by my assigned questions and upload within 30 minutes after completing this lecture. And listening this lecture, you need to perform those questions by using the formulas that I have discussed in this video. The question will be uploaded soon and you will have 30 minutes to solve those questions. This is all about today's lecture, and if I sum up the topic that we have discussed in our today's lecture, that was typical capital budgeting decisions, in which we discussed about screening decision and preference decision. Then we discussed that concept of time value of money, in which we calculated and or we discussed about the present value formula, the future value formula, and what will be the results of present value if we get positive result, if we get zero result, if we get negative result. In the same way, we discussed about working capital. Working capital involved the difference of, or we can say it is the difference of current assets and current liabilities. Then we discussed about the factor of investment, internal rate of return, in which the ratio of investment required and annual net cash inflow will give the factor of internal rate of return. Then comes the profitability index, that is the ratio of net present value of the project and investment required. Payback period tell us in how much time our initial investment amount will be recovered. Then we discussed about the simple rate of return formula, that was annual net operating income and initial investment. By calculating this, we will be able to know about the simple rate of return. After it, we discussed about post audit of investment projects, whether the results are beneficial, whether the results are acceptable, whether our investment will be helpful in future or not. So this was all about today, and the question is uploading soon. You need to solve those questions, or you need to put those values in all these formulas and upload the assignment. Thank you.